welcome to the Deep Dive. Today we are taking on, well, a truly massive task.
We really are.
We're synthesizing what is basically the absolute pinnacle of current thinking on human decision-making, on performance, risk, and just the surprising way our minds are built.
Right. Think of this as a shortcut.
A shortcut to getting fluent in the very complex science of what it takes to succeed when you're under pressure.
That's it. Our source material today pulls together the work of 8 leading experts. We're talking psychologists, behavioral economists, performance coaches.
And developmental researchers.
Exactly. And our mission is to figure out how we as humans can make successful choices in a world that, fundamentally resists being predicted. We're going to dive deep into that tension between complex math and, simple rules.
And pull apart all the myths around talent and what expertise really is.
And we've got some genuinely shocking insights coming, things that challenge core assumptions.
I'm really excited for this. We're going to find out why a 7-year-old child wearing a hidden Star of David ran into a German SS soldier, and how that single terrifying complex moment inspired the foundational work of Daniel Kahneman.
We'll also learn why, embracing a little bit of ignorance can actually make you a better investor.
And why the most important job a baby has is to be and this is a quote, the R&D operation of the human species.
It's basically a roadmap for how to operate effectively when the world is uncertain. So let's jump in.
Let's do it. First, the complexities of human judgment.
And for that, we have to start with Daniel Kahneman.
There's no other place to begin. His work, along with his late partner Amos Tversky, it just fundamentally mapped the terrain of our cognitive biases. It effectively launched the entire field of behavioral economics.
He's often called the most influential living psychologist, and for good reason. I mean, his influence is just everywhere now, from public policy to high finance.
Even though he never set out to write, self-help books for traders or anything.
Not at all. His early work with Tversky was just so groundbreaking. They were studying judgment under uncertainty, and it all culminated in that definitive 1974 article in Science.
So what was the immediate impact of that paper? Because it sounds like they were actually kind of surprised by the reaction they got.
Oh, they were completely surprised. They published it because they knew the material was novel, detailing these heuristics like representativeness and availability.
But they didn't see the explosion coming.
No. Kahneman later said that the sheer speed and breadth with which their research was taken up, it went across sociology, economics, law, that showed them they hadn't just done some new science. They had articulated a fundamental truth about how we think.
A truth that people just immediately recognize in their own lives.
Exactly. It was this huge validation that they had moved beyond the normal confines of academic psychology.
Okay, so let's shift to his later work, the Nobel-winning stuff. He introduces this distinction that is just so crucial for understanding how we value our own lives.
Yes.
The experiencing self versus the remembering self.
It sounds simple, but it governs everything.
Everything from how you plan a vacation to how happy you think you are.
It's the ultimate cognitive confusion. The experiencing self is the one living life in the moment. It's how you feel right now, minute by minute.
And the remembering self.
That's the one that constructs the story of your life after the fact. It's the one that answers when someone asks, so how satisfied are you with your life? It does a quick evaluation based on memory.
And here's the problem, right? The remembering self has totally different priorities than the one that's actually living the life.
Profoundly different. The remembering self uses these mental shortcuts, primarily what he calls the peak end rule. It doesn't average the joy across an entire experience. It gives massive, disproportionate weight to 2 things. The most intense moment, the peak, and how the experience ended.
So a long, mostly pleasant experience that just ends poorly
is remembered as being worse than a short, intense experience that had a great peak and a good ending.
And that's the mechanism, right? That explains the confusion around things like travel. We prioritize building the memory over actually living the experience.
Think about the constant photography on a trip, the mandatory photos. If you just calculate the sheer amount of time you spend having the experience, walking, eating, relaxing, versus the tiny fraction of time you spend later looking at the photos.
The experiencing time is vastly greater.
It dwarfs the remembering time. And yet we make these expensive decisions about where to go and what to do based on maximizing the memory's potential.
The potential for a great photo or a story to tell.
Exactly. We're essentially sacrificing the quality of the present moment for the perceived future value of the memory. And that often means we enjoy the present less because we're so busy curating this future artifact.
That focus on looking back, on evaluating things, it brings us to what really derails high-stakes decision makers, especially when money's on the line.
Loss aversion.
Yes. And the insight here is so critical. He says, a person who has not made peace with his losses is likely to accept gambles that would be unacceptable to him otherwise.
And that quote just reveals the entire psychological trap. Loss aversion means the pain of a loss is roughly twice as powerful psychologically as the pleasure of an equivalent gain.
Twice as powerful.
So if you've taken a big loss in trading, in a business, even in a relationship, that loss just sits there. It's a cognitive and emotional debt.
So how does that debt lead you to make even bigger mistakes?
Well, if you refuse to accept that initial loss, your rational analysis, what Kahneman calls System 2 thinking, it gets completely hijacked by this emotional drive to just get back to where you were.
Getting back to even.
Right. And instead of sticking to your discipline strategy or making decisions on expected value, you're now driven by a purely emotional System 1 goal. Zero out that negative number. And this compulsion forces you to take these increasingly desperate, high-risk gambles that you would instantly reject if your P&L, your profit and loss, was in the positive.
So the mistake isn't the first loss.
No. The real mistake is the lack of mental discipline to just close the emotional account on that loss. That's what leads to the cascade of catastrophic, uncalculated risks.
The big takeaway from all of Kahneman's work seems to be the profound, even terrifying complexity of being human. And to really get his motivation, we have to go back to that personal story that inspired him.
It's an essential piece of the puzzle. The year is 1941. The Nazis are occupying France. Kahneman is just 7 years old, living under curfew, forced to wear the yellow Star of David.
Right.
One evening, he's out past curfew, and he sees a German SS soldier walking towards him, dressed in that ominous black uniform, an immediate life-or-death threat.
A moment of just pure terror.
Absolute terror. But what happened next was the ultimate contradiction. Instead of violence, the soldier pulls this small boy into a hug. He starts whispering to him in German, shows him a picture of his own son, and then gives Daniel some money before sending him home.
All while Kahneman is petrified that the soldier will see the hidden yellow star under his coat.
Yes. Experiencing this moment of profound human connection in the midst of abject fear.
So what was the lesson? The enduring lesson from that?
The lesson was the sheer, unbearable complexity of humanity. I mean, here was a man who belonged to an organization dedicated to systematically murdering people just like Daniel. Yet he was also a loving father, capable of this impulsive, protective tenderness towards a stranger's child.
That contrast.
That intense juxtaposition, the monster and the loving father coexisting in the same person, that's what fueled Kahneman's entire lifelong project, to understand the messy, contradictory machinery of the human mind.
That deep dive into psychological complexity really sets the stage perfectly for a radically different approach to decision-making.
Right.
The one championed by Gerd Gigerenzer, he shifts the focus completely. He argues that in a lot of real-world situations, we shouldn't be aiming for maximum complexity at all.
We should be aiming for maximum simplicity.
Through heuristics.
Gigerenzer's work directly attacks this fundamental difference between, solving an equation in a textbook and actually succeeding in the real world. And to get him, you first have to be crystal clear on the distinction between risk and uncertainty.
A concept that goes way back to the economist Frank Knight in the 1920s.
Right. So let's nail that definition down because it's foundational for everything that follows.
Okay.
Risk exists when you know all the possible outcomes and you know the exact probability for each one. Think of a roulette wheel at a casino. The odds are fixed, they're known, they're calculable.
And uncertainty.
That's when the probabilities are unknown, or maybe even the outcomes themselves aren't all known. Most of the real world, the stock market, medicine, the climate, that operates under uncertainty.
And the critical insight is that when you're faced with true uncertainty, trying to use complex calculations is often a mistake.
It's an exercise in overfitting. You build a model that fits the past data perfectly, only to have it fail, sometimes spectacularly, when the environment changes just a little bit.
Which is exactly why Gigerenzer argues for heuristics, these fast and frugal rules of thumb. He says they're not a sign of lazy thinking. They're actually superior tools in uncertain conditions.
Exactly. Because they're robust. They're built for speed and robustness, not for precision. They achieve that by ignoring a lot of the available data.
The classic example has to be Captain Sullenberger's landing on the Hudson River.
The miracle on the Hudson.
Yeah.
It's perfect. Both engines failed from a bird strike. He had seconds. Literally seconds, to decide if he could glide back to LaGuardia or if he was going to crash short.
He definitely didn't have time to pull out a calculator and run a 3D trajectory computation. So what rule did he use?
He consciously used the gaze heuristic. It's the same rule an outfielder uses to catch a baseball without thinking about it. If the ball seems to be moving up in their field of vision, they run back. If it's moving down, they run forward.
And for a pilot?
The rule is simple. If the airport's control tower is moving up in the plane's windshield, you are going to hit the ground before you get there. Steenbarger used that simple, robust rule to instantly confirm that landing short was inevitable. That's what forced the decision to go for the Hudson River.
Faster and more reliable than any calculation he could have attempted in that moment.
Absolutely.
This demonstrates the power of what he calls the less is more phenomenon, which is really highlighted by the recognition heuristic. This suggests that sometimes being ignorant is actually a competitive advantage.
I know, it's one of his most provocative findings. He ran this study where he asked German pedestrians who were semi-ignorant about American stocks to build investment portfolios.
Okay.
They were presented with pairs of cities, say Detroit and Milwaukee, and the Germans were told to invest only in the city they recognized. The Americans in the study, meanwhile, knew lots of facts about both cities, population, sports teams, crime rates, and they used all that data.
And the result was? Not what you'd expect.
Not at all. The portfolios built using that simple recognition heuristic, the ones based just on recognizing the city name, which is a pretty good proxy for major business importance, consistently outperformed the portfolios built by the Americans who were relying on a mountain of facts.
So the facts were just noise.
The facts actually distracted them from the single most important signal, which was recognition. The lesson is, in domains where recognition is strongly correlated with success, knowing what you don't need to know is the real expertise. Ignoring the noise is the skill.
Gigerenzer's critique goes even harder on the overly complex models used in high finance. He points to the Markowitz portfolio optimization model as a prime example of complexity just failing under uncertainty.
Oh, this is such a crucial point about the illusion of precision. The Markowitz model, it requires you to estimate hundreds of parameters, the expected return for every single asset, the variance of every asset, and the covariance between every possible pair of assets.
It's a huge amount of data.
It's massive. And Gigerenzer shows that for a pretty modest portfolio of, say, 50 assets, the number of estimates you need is so vast and the inputs are so unstable that any small error in your estimates gets magnified. It becomes error maximization.
So the model isn't just fitting the signal, it's fitting all the noise from the past data.
Perfectly. It performs beautifully on past data, but because it's so unstable, it fails on future uncertain data. And the simulations are just damning. They show that you would need approximately 500 years of stable stock market data before the complex Markowitz calculation would reliably outperform a simple equal weighting rule.
Just dividing your money equally, the 1N rule.
Right. And that number, 500 years, it just shows the hubris of trying to be precise in an uncertain world. The simple heuristic wins because it's robust. It's not sensitive to those estimation errors.
This need for simplicity also applies directly to how we communicate uncertainty. And Gigerenzer is adamant that we should always demand the absolute truth behind relative risk claims.
This is such a critical skill for you, for the listener, to develop. Relative numbers are used all the time to manipulate us, especially in healthcare.
Okay, give us the mammography screening example.
A typical brochure might say that screening reduces your mortality from breast cancer by 20%. And 20% sounds pretty substantial.
It does.
But when you look at the absolute risk, the picture changes completely. If we look at 1,000 women who don't get screened over a decade, statistics show roughly 5 of them will die from breast cancer.
Okay.
Now look at 1,000 women who do get screened, roughly 4 will die. The difference between 5 and 4 is 1, so the absolute risk reduction is 1 in 1,000.
1 in 1,000 versus a 20% reduction.
The 20% is mathematically correct, but it's psychologically misleading. It implies a much bigger effect than the data actually warrants. So Gigerenzer's rule is simple. Never be impressed by relative risk. Always ask for the absolute numbers.
This critique of over-relying on calculation and the illusion of precision, it's shared by Spyros Makrodakis. He confronts the entire forecasting myth head-on.
He really does. He basically says, we prefer the comfortable fantasy that we're in control over the stressful reality that we're not.
And he proved this with decades of forecasting competitions.
Yes, competitions that consistently show that these sophisticated econometric and AI models just failed to beat simple methods. And the initial reaction from the academic world was just pure resistance. They assumed Macrodakis and his team just didn't know how to use the sophisticated models correctly.
But the competitions were rigorous.
They were. So in later rounds, he had the world's top experts apply their own advanced models, only to confirm his original conclusion. In uncertain environments, simplicity, like a simple moving average, it just performs better because it's less likely to chase noise and create these unstable predictions.
And this leads to his most jarring finding, the zero prediction claim. He argues our ability to forecast the three most important things in life is basically nil.
He states it so bluntly. Our ability to forecast health, wealth, and happiness, the three things humans care about most, is absolutely zero. And he says this even applies to fields like medicine, which spends just a colossal amount of money on diagnostics and intervention.
It feels so radical. How does he support that, especially for medicine?
He points to the constant necessary changes in expert medical advice as proof of the underlying uncertainty. Why are doctors always changing their recommendations on key things?
Right.
Think about the evolution of advice on taking a daily aspirin, or the shifting landscape of preventive screening tests like mammograms or prostate exams. The evidence often shifts, suggesting that maybe the previous screening regimes were actually causing more harm than good through false positives and unnecessary procedures.
So the system is just too complex.
The human body is this incredibly complex, interconnected system. And that means even with massive amounts of data, true long-term certainty is elusive. Macrodakis' point is we have to stop believing in high certainty for these complex problems and instead adopt a mindset of humility and constant adaptation.
So if certainty is a myth and complexity often fails, how do we actually become experts? How do we perform reliably when things are uncertain?
Well, that brings us straight to K. Anders Ericsson, who completely shifted the conversation away from this idea of innate talent and focused relentlessly on one thing: deliberate practice.
Ericsson's work is like a specific, actionable recipe for high performance.
It is. He spent his entire career just dismantling this notion that high achievement is a matter of natural gifts. The concept he defined is purposeful practice, and it has these 4 non-negotiable parts, starting with the most critical one.
Immediate feedback.
Immediate feedback. It is the absolute cornerstone.
Why is it so important?
Because without it, you are practicing blind. You have to have a mechanism to know instantly if what you just did was right or wrong, or if it could be better.
Okay.
So contrast a chess player who sees the immediate consequence of every single move they make
with the doctor making a rare diagnosis.
Exactly. The doctor might have to wait years for the true outcome, or maybe never even see the patient again. The doctor's domain has delayed, ambiguous feedback, which makes deliberate practice incredibly difficult. The chess player has the ideal environment for improvement.
Because that immediate feedback allows for quick experimentation and correction.
Right. And Ericsson also proved that this kind of practice creates highly specific, domain-specific skill, not some kind of general improvement in intelligence. The digit memory task is the perfect illustration of this.
Tell us about that.
He worked with a volunteer who started with a totally average digit memory capacity, about 7 digits. After weeks of intensive training, the volunteer managed to recall sequences of 80 digits. 80. He eventually pushed it even higher by developing these complex mnemonic structures, like associating numbers with running times. But, and this is the key part, when they tested him on a different task, like remembering sequences of consonants, his memory was still just average.
So his general memory hadn't improved at all?
No, he had just developed this intricate, highly specialized skill just for processing numbers.
Which proves that practice fundamentally changes us, right down to the physical structure of our brains.
Yes, and the London taxi driver study showed this perfectly.
The knowledge.
The famous London knowledge. It's maybe the highest standard for spatial memory training on the planet. Cabbies have to spend years learning over 10,000 streets and the most efficient routes between any 2 points. And brain scans showed that the ones who successfully completed this immense practice had actual physical enlargement in their posterior hippocampus.
The part of the brain for spatial memory.
Right. It's physical proof that skill isn't abstract. It's a structural change in your brain.
But Ericsson also points out there's a maintenance clause on that change.
It's not permanent if you stop. Ericsson found this across all domains. Performance requires maintenance. If those taxi drivers stopped practicing the knowledge, their performance, and those physical changes in their brain would slowly revert. High achievement is not a destination. It's a process that requires continuous energy.
We have to pause here and correct the biggest misconception of his work, which is a 10,000-hour rule.
Oh, it's a massive oversimplification. Erickson explained that in his original study of violinists, 10,000 hours was just the average amount of practice the top performers had accumulated by age 20. It was descriptive, not prescriptive.
So it's not a magic number.
Not at all. He always emphasized that spending 10,000 hours playing the violin badly, without a coach, without intensity, accomplishes nothing. The practice has to be deliberate. It has to be focused, constantly pushing you just outside your comfort zone and done with full, deep concentration.
Practicing without full concentration is just wasted time.
Completely wasted.
So what about the psychological barrier? The thing that stops people from even starting, that immediate jump to, I can't do that.
Erickson saw the "I can't claim the belief that you lack the innate talent" as a convenient psychological excuse. It's an excuse to avoid spending massive amounts of energy. We instinctively fear wasting effort, so we retreat into this belief that the barrier is fixed and it's not our fault.
He had that great anecdote about his colleague who wanted to learn Spanish.
Right. A colleague who had always struggled terribly with languages. He only succeeded in mastering Spanish after he fell deeply in love with a native Spanish speaker.
So the motivation provided the energy.
Exactly. The love provided the concrete reason, and the social interaction provided the immediate, constant emotional feedback loop he needed to sustain that intense, deliberate practice. Erickson's argument is that the right environment and high-quality opportunities often just completely outweigh the supposed limits of innate ability.
Okay, building on that focus on structured effort, we can move to Brett Steenbarger, who connects high performance directly to managing your mental state, specifically the concept of flow.
Right. Flow, which was popularized by Mihaly Csikszentmihalyi, is that state of total immersion, where you're just absorbed in what you're doing, you lose track of time. But crucially, it only happens when the challenge of the task perfectly matches your skill level.
Not too easy, not too hard.
Right. If your skill is too high for the challenge, you get bored. If the challenge is too high for your skill, you get anxious and overwhelmed.
And Steenbarger applies this directly to high-stakes environments like trading. So what's the guaranteed way to shatter your flow state?
Poor emotional management. And it's usually triggered by taking on too much risk, what he calls poor position sizing.
Okay, let's clarify that for the listener.
So your P&L, your profit and loss, is the running tally of how much money you've made or lost. If a trader takes on a position size, the amount of stuff they're holding, that is too large for their capital, or, more importantly, too large for their emotional tolerance.
The ups and downs of the P&L become too much to handle.
The volatility just overwhelms their emotional bandwidth. The challenge suddenly exceeds their skill to cope with the stress.
And that pushes them out of flow and into anxiety or panic.
Exactly, and that just ruins their ability to process information and leads to mistakes. Steenbarger's insight is that to maximize flow, you have to be rigorous about risk management to keep that emotional challenge right in the sweet spot for your skill level.
The way experts maintain this level of performance, even when stress is high, is through disciplined routines and checklists.
Yes. They codify their best practices until they become habits. You can think of Ted Williams, the legendary baseball hitter. He famously diagrammed the strike zone into specific zones because he knew exactly where he had the best batting average. He turned his optimal performance into a clear, non-negotiable process.
So experts create these checklists, like the ones Atul Gawande talks about in the Checklist Manifesto.
Right. To ground themselves and ensure they execute that optimal process, especially under stress. A trader won't risk any capital unless A, B, C, and D on their pre-trade checklist are all met. When you're in flow, you're executing a habit. You're not inventing a new process on the fly.
And finally, Steenbarger ties physical fitness and health directly to performance.
Yes, because the research is clear. A positive emotional state is directly correlated with better information processing, more productivity, and higher creativity. So physical preparation, prioritizing sleep, good nutrition, exercise, it isn't a luxury.
It's a critical input for performance.
It's a critical input. Physical fitness maximizes your emotional energy, and that's what fuels the focus, the concentration, and the stamina you need to sustain deliberate practice and stay in that flow state.
From the disciplined world of expertise, we make this fascinating turn back to developmental psychology with Alison Gopnik. She calls babies the R&D operation of the human species.
It's a perfect metaphor for their just ceaseless, wide-ranging learning.
It really is.
Gopnik's research shows that a child under 3 discovers more about the world in a short amount of time than most adults do over years. And this highlights this inherent tension between two vital evolutionary strategies.
Okay, what are they?
Exploration, which is the wide, inefficient search for new information, and exploitation, which is using what you already know efficiently to get a known reward.
And this exploration phase is structurally built into our lives through an evolutionary paradox, our incredibly long childhood.
It's twice as long as our closest primate relatives. A chimpanzee is mostly self-sufficient by age 7, humans. We aren't really productive until our teens, even in ancestral settings.
And that long period of immaturity requires a huge social investment.
A huge investment. Pair bonding, grandmothers, group collaboration. And the evolutionary payoff for all of that is incredible adult flexibility and a superior capacity to learn. Our brains are designed to explore widely first, before settling on a specific set of skills for exploitation.
The most surprising part of this R&D operation, though, is their sophisticated ability to handle probability.
The Bayesian babies concept.
Right.
Children, even 8-month-olds, are performing this sophisticated, unconscious statistical analysis. They're doing Bayesian inference, adjusting their beliefs based on new evidence, far more efficiently than adults often do.
And Gopnik notes that preschoolers sometimes have an advantage over adults.
They do, because they're better learners. They rely less on entrenched prior knowledge.
So as adults, we filter new information through what we already think we know.
Exactly. We're optimized for exploitation. We need an overwhelming amount of new, contradictory data to fundamentally change our minds about something. But children, they know less, so they're less constrained by prior beliefs. They pay close attention to the data in front of them, and that allows them to infer causal structure very quickly. Like which button makes the toy light up? Their brains are just fine-tuned hypothesis-generating machines.
This exploration is rewarded by the paradox of play, which can look useless, but is actually essential for building resilience.
Play is, by definition, doing things without an immediate, measurable benefit. It's the reward for that wide-ranging, inefficient exploration. If you train any system, a child, an animal, a robot, to do just one thing really well, it becomes brittle.
Right.
Gopnik cites this example of a roboticist who let a robot just spend time playing, messing around, doing silly dances. When that robot suddenly lost a leg, it could quickly figure out an adaptive strategy to walk again.
Whereas a robot trained only for maximum walking efficiency would have just crashed.
It would just fallen over. Play builds the flexibility you need to deal with unknown unknowns.
And crucially, this kind of exploration requires a very specific kind of environment.
Stress and nurturance play these key opposing roles. A protected, nurturing environment provides the safety net that's required for exploration. Stress, on the other hand, especially early in life, it forces premature maturity. It pushes you immediately into exploitation mode, which limits your long-term flexibility and development.
So nurturance isn't about educational flashcards.
No, it's about providing the emotional security that allows a brain to just spend time exploring the world widely.
Okay, so let's transition now to how adults can try to regain that probabilistic exploratory mindset. And that starts with Philip Tetlock and the art of quantifying uncertainty through superforecasting.
Tetlock's Good Judgment project just completely changed how intelligence communities think about forecasting. They found that talented, ordinary citizens, not professional analysts, could consistently beat intelligence professionals.
And the key was a focus on explicit quantification.
Exactly. The key difference was their willingness to express their forecast in specific probabilities, like a 65% chance, instead of using vague language like, it's likely.
And one of the foundational differences between a superforecaster and an average person is the disciplined use of the base rate principle.
This is the critical first step that almost everybody skips. We tend to jump immediately to what's called the inside view. The base rate principle forces you to start with the outside view. It's the general statistical likelihood of an event happening in a broad category. For instance, if you're predicting whether a new coffee shop will succeed, you don't start with that specific shop. You first look at the overall success rate of all new coffee shops in that city. That's the base rate.
And then you adjust based on the specifics of this particular shop.
Exactly. You adjust that base rate, the outside view, only after you incorporate the specifics, the inside view, the location, the quality of the owner, the competition. But the average person ignores the outside view completely and just jumps straight to, oh, this owner is so passionate, this place has to succeed. And that leads to a biased, overly optimistic forecast. Good forecasts always start with a robust statistical base.
So if Tetlock gives us the structure for quantifying uncertainty, Annie Duke, drawing on her experience as a professional poker player, teaches us how to navigate the messy emotional reality of it.
Poker is the perfect laboratory for this. It was modeled on John von Neumann's game theory, and it forces you to make decisions under conditions of hidden information and high volatility.
Right. You can make a perfect decision, the one with the highest expected value, and still lose the hand 70% of the time just because of luck.
Right, and that unavoidable volatility, that inability to perfectly separate skill from luck, that's what causes tilt.
And she defines two different types of tilt.
The first one, short-term tilt, is the easier one to spot. It's when you start seeking out volatility right after a bad loss. It has physical cues, sweaty palms, your face gets flushed, your heart rate spikes.
So how do you fight that?
You have to engage your rational frontal lobe. You physically step away from the table, you analyze the hand you just lost strategically, and you force that system 2 thinking to override the emotional reaction from your limbic system. The analysis acts like a circuit breaker.
The second type, long-term tilt, sounds way more insidious.
It is. It's volatility avoidance. It's the fear of enduring the necessary losses that come with good strategy, and it leads to overly conservative decisions.
Like quitting a game when you're just slightly ahead to book the win.
Exactly. You quit early, and you miss out on hours of high expected value play that might have come later. Or in business, it's refusing to take a calculated high upside risk just because the potential downside is emotionally uncomfortable. This tilt is fueled by the desire to avoid the pain of future losses, which, ironically, just guarantees lower long-term returns.
And this ever-present role of luck is why Duke stresses that we absolutely must decouple decision quality from the outcome.
This is maybe the most crucial takeaway of all. Because of luck, a good decision can lead to a bad result. And a terrible decision can lead to a great result.
And we have this deep, ingrained flaw.
We do. We naturally attribute good results to our own skill because it flatters our ego. And we attribute bad results to bad luck because it protects our self-narrative. But that tendency completely destroys our ability to learn. If you just blame a bad outcome on luck, there's nothing in your decision process that you need to fix.
So practically, how do professionals create the distance they need to do that decoupling?
They create structures to enforce objectivity. Duke is a huge advocate for decision journals, or what are called premortems. Before you make a high-stakes decision, you write down your reasoning, your probabilities, what outcomes you expect.
So you have a record.
You have a record. So when the result comes in, good or bad, you can compare it to your original stated reasoning. It forces you to analyze the process you used, not just the result you got. You have to fight that urge to treat 70% odds as if they're 100%.
And that fight against certainty is the very essence of the probabilistic mindset.
We saw this so vividly in the 2016 U.S. election. A lot of people were just shocked by the outcome.
Totally shocked.
But if a forecaster like Nate Silver gives a candidate a 30% chance of winning, that's substantial. I mean, in poker, a 30% shot is a very real possibility. A player who ignores those odds will lose a tremendous amount of money over time.
So acknowledging I'm not sure that the probability is 30% or 70%, not 0 or 100%, that isn't paralysis.
No, it's the starting point for effective strategy. It's how you know to check your biases, gather trusted opinions, make the highest probability choice you can, and then accept the volatility that just comes with living in an uncertain world.
Wow. What an incredible synthesis of the human experience. We started with Daniel Kahneman and his revelations about our cognitive complexity, the debilitating distortions of loss aversion.
And we've ended up with Annie Duke and Philip Tetlock teaching us how to live a disciplined, probabilistic life that's designed to manage those very same innate flaws.
The overarching lesson from all these masters seems clear. The path to superior performance and making good decisions in a complex world isn't about maximum calculation. It's not about striving for a certainty that doesn't exist.
No, it's achieved through a multifaceted discipline. It's about adopting the simple, robust heuristics that Gerd Gigerenzer champions to handle uncertainty, while at the same time creating these explicit probabilistic systems, like Tetlock and Duke advocate for, to mitigate the biases that Kahneman so brilliantly uncovered.
And critically, it's that conscious discipline structure that creates the mental space and the stability you need to maintain the sustained, highly focused, deliberate practice that Kay Anders Ericsson showed is necessary for true mastery.
And if we accept that profound piece of wisdom from Spyros Magridakis, that we have zero reliable ability to forecast health, wealth, or happiness, the three things people care about most, then we have to acknowledge a massive limitation on our control over the future.
So we'll leave you with this final provocative thought. If our ability to forecast our most important long-term outcomes is fundamentally zero, what profound change should we, as learners and as decision makers, make to how we prioritize our energy and our resources today?
Welcome to the deep dive. Today we're doing something a little different. We're cutting straight through all the noise.
All the technical analysis, the arcane indicator.
Exactly. We're going to investigate the internal architecture of market success. And for this, we've brought together insights from 4 really titans of trading psychology. We're talking about Van Tharp, Alexander Elder, Daniel Crosby, and Charles Faulkner.
And what's so powerful, what really unites all of them is this almost heretical truth.
Which is?
That exceptional performance in the markets, it's not an external skill you learn. It's not about finding the perfect setup. It's an internal transformation.
A challenge of belief, discipline.
And managing your own flaws. I mean, we've seen it 100 times. Traders with these brilliant, mathematically perfect models, and they just fail.
Repeatedly.
Right. Because their internal operating system, their psychology, it's just fundamentally incompatible with the raw uncertainty of the market.
So our mission today is really to unpack that, to get into the why. Why does the market seem almost perfectly designed to crush the human ego?
And more importantly, how can you, the listener, establish a framework of, ironclad rules and mindsets that let you succeed precisely where your instincts fail?
We're going to move beyond the usual platitudes, control your emotions. We're getting into the neuroscience, the statistics, the actual architectural design of a successful trading mind.
So let's start with a foundational question, a critical one. And we want you to carry this with you throughout this entire deep dive.
Okay.
Are you truly trading the market, this abstract, chaotic reality of supply and demand? Or are you actually trading your beliefs about the market?
And what if that deep primal financial instinct, the one everyone tells you to trust? What if it's statistically definitively proven to be wrong 100% of the time?
Today, we are stepping inside the machine.
Let's start with the self. I think we have to. And Van Tharp really placed it at the very center of his framework.
He did.
Tharp, who was a true pioneer in this field, he posits a premise that, honestly, it can be genuinely shocking when you first hear it.
It really can be.
He suggests that most of us are essentially emotional robots.
Robots, yeah. Programmed by our deep-seated beliefs, and we're just navigating what he calls an illusory world.
It's the ultimate psychological realization. It's often compared to the movie The Matrix, right?
It's a perfect analogy. You think you're looking at a neutral chart? You think you're responding logically to a support level or some news headline?
The data says X, so I will do Y.
Right. But what Tharp argues is that what you're actually doing is executing subconscious code. Beliefs about risk, scarcity, your own self-worth, your need for control.
And this code was written long before you ever placed a trade.
Long before. By your environment, your parents, maybe your early financial traumas. It's all running in the background.
So true transformation, in Tharp's view, it has nothing to do with finding a new indicator.
Not at all. It's psychological deprogramming.
You have to identify and then sort of neutralize those deeply ingrained subconscious beliefs that are they're not useful.
They're not useful for making money in what is, at its core, a statistically random environment.
And this is where the nuance is just.
Yeah.
It's so critical. It's a point a lot of people who read Tharp's books, they kind of gloss over it.
They do. These non-useful beliefs.
Oh.
They're not just ideas. They are charged with incredibly high emotion.
So you can't just think your way out of them.
You can't. It's one thing to read a book and agree, yes, fear is bad and I should cut my losses quickly. Intellectually, that's easy.
Everybody agrees with that.
Everybody agrees. But it is an entirely different universe to actually achieve the neurological implementation of that idea when you're down 5% and the market is tanking.
Okay, let's dig into that practical difference right there, because that's key. If a listener intellectually gets it, I need to cut my losses. But they still freeze. Their hand hovers over the mouse when the price hits their stop. What does releasing the emotional charge practically look like? It sounds more like therapy than trading prep.
That's an excellent question because it has to be actionable, right?
Okay.
The practical step is to first recognize that moment of hesitation, that physical feeling, the tightness in your chest, the spike of adrenaline, that is the emotional charge fighting your logical rule.
So the body is betraying the mind.
The body is running the old program. And Tharp's work, and others like him, suggest the work can't be done in that moment of stress. Mm-hmm. It's too late. You have to do it outside of market hours.
So what do? You
have to identify where that belief came from. Was it a childhood where you were taught that losing anything was a catastrophe? Was it an early devastating trade that burned this fear into your nervous system?
And once you find it,
you use techniques, things like NLP or even meditation, to separate the raw emotion from the memory of the event. You're trying to render the belief inert. You change the feeling of what a loss is. You have to transform it from catastrophe into just a business expense.
Like paying for inventory.
Exactly. If you try to just force the behavior, just hit the sell button, without releasing that underlying emotion, the stress of the live market will always cause you to revert back to the old programming.
That makes perfect sense. The market is the ultimate pressure test, and if that emotional foundation of the old belief is still there, it'll just crack the new discipline instantly.
Every time.
Tharp has this really simple, but I think profound test to show how individual this all is.
The dog test.
Yeah. If you ask 10 people to just think of a dog, they're all going to picture something completely different.
Right. One person sees a friendly golden retriever. Another sees a snarling German shepherd from their childhood.
A third might picture a little poodle, and a fourth might remember a dog that bit them 20 years ago. The word dog is neutral data.
It is. But our individuality assigns this unique, emotion-laden meaning to that neutral data. And it's exactly the same with market data.
When you look at a chart, you're not seeing objective reality.
No. You are seeing your history, your fears, your hopes, your programmed expectations, all projected onto that chart. You might see the exact same head and shoulders pattern that gave you a huge win last month.
And you feel excitement, anticipation.
But your neighbor, looking at the very same screen, sees the pattern that wiped out his account last year. And he feels pure terror.
So you are not trading the market.
You are trading your unique, programmed beliefs about the market.
And if those beliefs are flawed, which for most of us they are, they create the perfect foundation for what Daniel Crosby identifies as the primary driver of all investor failure.
Which is ego.
Ego.
Crosby is absolutely ruthless on this point.
Yeah.
He calls ego the one single bias that emboldens all other biases.
What does that mean, emboldens?
It's the engine. It's the relentless little voice of overconfidence that convinces us that the rules, the rules of probability, of history, of risk management, they apply to everyone else.
But not to me.
But not to us. We're different. We're smarter. We're quicker.
He breaks it down into 4 core biases that drive this misbehavior, and they all kind of feed that central ego.
They do. The first is ego itself, like we said. The core belief that you're smarter or luckier than the average person.
Which, statistically, you're probably not.
Almost certainly not. The second is emotion. This is the fast, hot state. The anger, the euphoria after a big win, the gut-wrenching fear during a drawdown. It's the state that just bypasses any rational rule structure you've built.
And the third one is fascinating. He calls it attention.
Yeah, this one is subtle, but so powerful. We're constantly confusing what is salient or loud, what's on the front page of the financial news, what's flashing red on our screen, what some guy in a chat room is screaming about.
We confuse that with what's actually probable.
Exactly. We focus on the dramatic headline, the story, rather than the boring, underlying base rate of probability. And the fourth, finally, is conservatism.
Which sounds like a good thing, but it's not.
It's incredibly dangerous. It's the preference for the status quo, which in trading usually manifests as inaction. We hate to sell a loser because doing so makes the loss real. It formalizes our failure.
So we hang on, we hope, we tell ourselves it'll come back.
Which is often the most destructive path you can take.
But this all leads to what I find to be the most profound paradox that Crosby presents, which is that true market greatness, true success, is weirdly predicated on the admission of mediocrity.
It sounds so counterintuitive, doesn't it?
Yeah.
But it is absolutely essential. You have to start from the place of admitting, truly accepting, that you are, in his words, flawed, mediocre, and prone to all the same stupidity as every other retail participant out there.
And the data on this is just brutal. The correlation between how people think they're doing in the market and their actual measurable performance is basically zero.
It's zero. People assume they're beating the market, but systematic underperformance is the statistical norm.
So this realization of your own mediocrity, it's not self-defeat. It's actually a structural advantage.
It's the ultimate advantage. If you start from the position that you are biologically and psychologically predisposed to screw this up,
Then what do?
you build systems to protect yourself from yourself. You build ironclad rules. You automate your exits. You use disciplined mathematical position sizing. You delegate all the important decisions away from your flawed in-the-moment self.
So if your ego is whispering, I'm smart, I'll know when it's time to get out.
You're doomed. It's over.
But if the admission of mediocrity tells you, I am flawed, Therefore, I will hand over the exit decision to this preset mechanical rule I created when I was calm and rational.
Then you achieve consistency. It is a profound act of humility that leads directly to market survivability.
It's a fantastic self-check for anyone listening right now. Think about the Dunning-Kruger effect.
The most incompetent are often the most confident because they lack the self-awareness to recognize their own incompetence.
So Crosby suggests that if hearing this material, hearing us talk about the need to admit your own flaws, the supremacy of rules over gut feeling, if that's generating feelings of anger or denial or defensiveness in you right now,
That's your ego.
that's the ego confirming its presence. That defensive feeling is the primary enemy you need to conquer.
Because if you're sitting there thinking, oh, this is interesting, but it only applies to those other dumb people, your guard is completely down.
And the smarter you are, the worse it can be.
Arguably, yes, because your rationalizations for your mistakes become that much more sophisticated.
Okay, this brings us to a really crucial transition point. If our ego guarantees we overestimate our ability to predict the future, how does the market, which operates on pure probability, crush that overconfidence and force us to accept reality?
To succeed, you have to fundamentally change your model of the world. You have to move away from simple prediction and toward probabilistic management. And Alexander Elder, who brings his background in psychiatry to the table, gives us the perfect intellectual framework for this.
He does this by distinguishing between two very different types of causality.
That's right. The first type, the one our brains are wired for and the one we desperately crave, is dynamic causality.
This is the world of simple physics, right? It's predictable.
Perfectly predictable.
Okay.
If you push a pencil on a desk, you know exactly where it's going to go. Cause, effect. We want trading to be like that. If I buy the breakout, then the price will go up. It's satisfying. It's linear.
But it's not reality.
It is not the market's reality. The market operates entirely on the second type, statistic causality.
The probabilistic universe.
The probabilistic universe, which is so much harder for us to digest emotionally. Elder uses the classic analogy of pulling colored balls from a box.
Let's walk through that.
Okay, so imagine you have a box with 60% green balls and 40% yellow balls. You have an edge. Over the long run, you should always bet on pulling a green ball.
Simple enough.
But the reality of the market is that the possibility of pulling 3 or 4 or 5 or even 7 yellow balls in a row, a losing streak, what we call variance, is not just possible, it is statistically guaranteed to happen over enough trades.
And that's the psychological trap. We know our system has a 60% edge, but when the market hits us with 3 unexpected losses in a row, our fast-thinking System 1 brain, our ego, just starts screaming.
And system is broken, the market has changed, this doesn't work anymore, get out.
Exactly. Even with a fantastic system, if you bet a huge chunk of your account on the certainty of the next trade being a winner,
ruin is guaranteed. The moment that normal expected variance catches up with you, you're done. The statistical reality of the market does not care one bit about your need for certainty.
So if you risk, say, 20% of your account on a single trade, a 3-loss streak, which is highly probable over 100 trades, could wipe you out.
It could wipe you out, even though the system itself has a positive expected value over the long run.
This conflict, this war between our desire for simple dynamic causality and the market's reality of statistical causality is what destroys most accounts.
And Elder's own story, his own journey as a trader, illustrates this perfectly.
He talks about his early days, right?
Yeah, he details these massive emotional equity swings. He'd run his account up 50%, even 80%, and then crash right back down. And he'd repeat this cycle for years.
And he was using sound technical methods the whole time.
The same methods. His strategies were consistent, but his performance was wild. All over the place. And then he had a breakthrough.
What happened?
The turning point came when his account size grew to around $60,000. He noticed that once he crossed that threshold, the crazy swings smoothed out, and he started winning consistently.
So what was so magical about $60,000?
The realization he had was just profound, and it had nothing to do with his entries or his indicators. He realized that for most of his early career, he had been unconsciously trading a fixed, comfortable dollar size.
Meaning he risked the same amount of money per trade.
Right. Let's just say, for example, he was comfortable risking $1,000 per trade. He did that regardless of his total account equity.
So when his account was small, say $20,000.
That $1,000 was 5% of his capital, maybe more. He was violating every sensible rule of money management without even knowing it.
But once the account grew to $60,000, that same comfortable fixed risk of $1,000.
suddenly fell into a viable risk percentage. It was now only about 1.6% of his total capital.
Wow, so he accidentally fell into proper money management.
Precisely. He started following strict risk rules simply by hitting a higher capital threshold, even before he'd intellectually grasped the importance of those rules. His own psychological comfort zone accidentally enforced mathematical viability.
That's an incredible story. And it just powerfully demonstrates that managing your exposure, your risk relative to your capital is the great stabilizer. It's far more important than entry timing.
Far more. And this whole challenge of living in statistical uncertainty is what Annie Duke, coming from the world of professional poker, just hammers home.
Humans are terrible at this. We struggle to accept that something can be 70% likely to happen and still fail 30% of the time.
We see that 30% chance of failure, and our brain, which just craves certainty, it rounds it down to 0. It's not going to happen.
You see this all the time. Think about the massive collective shock after some low probability event occurs, like an election outcome or a financial crash that nobody saw coming.
Right. We treat the small probability as if it's non-existent. So when the rare event does happen, we don't chalk it up to probability playing out. We attribute it to chaos or manipulation or some external force.
Which just reinforces the wrong idea that the world is chaotic rather than probabilistic.
So the crucial skill for any consistent trader, the thing you have to master, is to fundamentally disconnect the quality of your outcome from the quality of your decision.
This is the difference between a professional and a gambler.
100%. If you win a trade, it does not automatically mean your decision was good. You might have just gotten lucky. And if you lose a trade, it doesn't mean your decision was bad. You may have just hit the 30% probability of failure on a great setup.
Taking credit for those lucky wins is so dangerous.
It's disastrous.
Yeah.
Because it reinforces poor, non-systematic behavior. It trains you to be a gambler.
And on the flip side, blaming a calculated loss on bad luck stops you from learning anything.
Of course. When you categorize a bad outcome as luck or the market being rigged, you're offloading responsibility. Your decision process never gets reviewed, never improves. And your ego loves that loop because it maintains the self-image of, I'm a brilliant trader who just got unlucky.
So what's the practical strategy here? Annie Duke offers one.
She suggests using the word luck, or even brilliance, as a trigger word, a mental stop sign. The moment you think it, you stop the emotional hot state from taking over.
And instead, you engage the slower, more analytical part of your brain.
Your prefrontal cortex.
Yeah.
You force yourself to analyze the process. Did I follow my rules? Was my risk size appropriate for this trade? Was the information I acted on reliable?
You focus on the decision, not the outcome.
Because if you focus on the process, over 100 or 1,000 trades, your long-term expected value will improve. You're constantly refining those 70% decisions, regardless of whether any single trade was a winner or a loser.
You replace the satisfying but ultimately ruinous search for short-term certainty
with the sustainable professional practice of long-term optimization.
Okay, so building on that mathematical necessity of probabilistic thinking, we arrive at what Van Tharp considers the absolute key, the holy grail of market success.
Position sizing.
Position sizing. For Tharp, this is not just some risk management tool you tack on at the end. It's the entire architecture for meeting your financial objectives.
He is completely 100% dogmatic about this. He states very clearly that position sizing, the algorithm that tells you how much to trade, is the only mechanism you have to meet your goals.
Whether those goals are aggressive growth or low volatility or just minimizing your chance of ruin.
It's all in the position sizing.
So if your entry system just tells you when to measure your edge,
your position sizing model determines how profitable that measured edge is allowed to become.
And it's wild how backwards most traders have this. People spend 90% of their energy trying to find a better entry, which might give them an extra 5% of edge.
While completely neglecting position sizing, which is the very thing that dictates the difference between a 10% annual return and a 100% annual return using the exact same entry system.
So to illustrate this, let's look at some of the mentors that Tharp modeled. Let's start with Ed Seykota markets money concept.
This is a fantastic example. It's an aggressive strategy, but it's also very protected, and it's rooted entirely in position sizing. The core idea is simple. You risk profits, not your core capital.
Okay, so how does that work in detail? Let's paint a picture.
Say a trader starts with $10,000. They have a strict rule. Only risk 1% of the initial capital. That's $100 per trade.
Okay, very conservative.
Very. Now, they have a few good trades, and their account grows to $12,000. They have a $2,000 profit cushion. Now, the market's money rule kicks in.
What changes?
They still protect that initial $10,000. That's sacred. But now they might risk, say, 10% of that $2,000 profit pool.
So now they're risking $200 per trade.
Exactly. They've doubled their risk size, which can dramatically accelerate their growth. If they hit a losing streak, they're only drawing down on that protected profit pool. They never even touch their initial core capital until all the profit is gone.
That's fascinating. So you're using risk capital not as a fixed percentage of the entire account, but as a dynamic percentage of the unrealized gains. The market is essentially financing its own risk.
You've got it. It lets you be incredibly aggressive on the upside while protecting your psychological base, that initial stake. It does require absolute rule compliance, though.
Of course. But the mathematical lever it pulls is just enormous.
Then you have another one, Bill Eckhart's pyramiding.
This is a classic trend-following technique.
It is. And it's another sophisticated position sizing method. Eckhart's system involves scaling into trades as they move in your favor, rather than taking your full position all at once.
Which is the direct opposite of what most retail traders do.
The total opposite. The common retail mistake is to average down. You buy more of a stock as the price drops, hoping to lower your average cost.
Which is just throwing good money after bad.
It is. Pyramiding does the exact opposite. It says, if the market is proving my hypothesis correct by moving in my direction, I should increase my exposure.
So how would that work?
You might start with a small position, say a 1R risk, right when the trend begins. Then, only after that first position is showing a 2R or 3R profit, and the trend is clearly confirmed, you add another small position, another 1R risk.
This maximizes your exposure to the biggest, most persistent trends.
And it severely limits your risk when the market is choppy or you're in a losing environment. It is a pure exercise in mathematical conviction.
But maybe the most powerful example of all, the one that really demonstrates the primacy of position sizing, is the work Tharp did with Tom Basso.
With the Serenity.
Right. He ran one of the most successful funds in that whole turtle program era, and he was famously mechanical about it. He called himself a businessman first, trader second.
And Basso's revelation is just. It's a game changer. He was able to show mathematically that if he plugged a system with random entry into his rigorously developed money management and exit rules.
Wait, random entry, you mean like flipping a coin? Heads I buy, tails I sell.
Essentially, yes. The system could still make money.
How is that even possible?
It's the genius of the structure. If you minimize your losses ruthlessly, which is the job of your exit rule, and you let your winners run indefinitely, which is the job of your position sizing and trend following rules, the timing of the entry becomes almost secondary.
So the system survives not because of any predictive genius,
but because the structure protects capital during the inevitable random noise, and it maximizes capital during those infrequent but very powerful non-random trends.
That is the ultimate proof. Risk management is the system. It just completely flips the whole emphasis.
And implementing these systems, any of them, requires ironclad discipline. Which brings us back to Tharp's wonderfully simple definition of self-sabotage.
Mistakes are simply not following your rules. That's it.
That is it.
And this is where he introduces the idea of quantifying your discipline using R multiples. This is the bridge you have to build between your psychology and your math.
Absolutely. The R multiple is just the ratio of your profit or loss to the initial risk you defined for that trade. It's so simple.
So if you decided your maximum risk, your 1R, was $500, and you followed your stop and lost $500.
That's a 1R loss. It's the cost of doing business. It was a successful trade in terms of process.
But if you broke your rule, you ignored your stop, and you let that loss run to $2,000.
That is a 4R loss. And that $1,500 difference is the precise quantified cost of your indiscipline.
And this normalization is so key because R multiples let you analyze your performance regardless of your account size. It tells you exactly how much your behavior is costing you.
You stop saying I lost a lot of money and you start saying I had a 4R loss because I failed to execute my 1R risk plan. That objectivity forces your analytical brain, your system 2, to take over.
And the ability to actually execute those rules under fire, that's built through hard prior work. Alexander Elder emphasizes this with a powerful analogy from his own life.
His escape.
Yeah. He talks about the preparation he did for his eventual escape from the Soviet Union. For 2 months, he skipped rope every single night to make sure he was in peak physical condition for when the moment came to run across the border.
The escape itself was the moment of action, the test. But the real work, the thing that guaranteed success, was the months of tedious, disciplined preparation in the calm.
Trading is identical. The moment you click the mouse to enter a trade, that's your run for the border. But your success or failure was already determined by the work you did beforehand.
Studying your system's historical performance, defining your rules, quantifying your risk, planning your trades before the market even opens.
If you wait until the market is screaming a panic sell-off, a euphoric rally, you're going to jump in reactively. You'll be using your flawed, impulsive System 1 brain.
And Elder points out that the very best buying opportunities, they happen precisely when the market is at its craziest. At the point of maximum danger, when the weak hands are panicking and dumping their positions.
But without that prior preparation, without your skipping rope, you're just going to be one of the weak hands, selling when you should be buying.
Which brings us full circle to Daniel Crosby's definitive gut check. And this is something that has to be repeated and automated until it's a reflex.
The thing that feels right in the moment, your gut instinct, is statistically wrong 100% of the time.
That urge to panic sell, to bet big on the next trade, because you're due for a win after 3 losses, to ignore your stop because the stock has to bounce back.
That is always the wrong impulse.
So the real transformation, it isn't about ignoring your emotions. You can't. It's about automating the hard-won lessons of history and market math into fixed rules that physically handcuff your impulsive, mediocre self.
To really win this internal war, we need to understand the underlying structure of our thoughts. And this is where Charles Faulkner's work is just brilliant. He deeply analyzes how our unconscious programming dictates our financial decisions.
And he often uses the lens of Daniel Kahneman's System 1 and System 2 framework to do it.
Just a quick recap for everyone. System 1 is fast, automatic, emotional, associative. It's our brain's default mode.
System 2 is the opposite. It's slow, logical, conscious, and it takes real effort to engage.
And the great lie we tell ourselves, according to both Faulkner and Kahneman, is that our intellect protects us from System 1's mistakes.
Yeah. In fact, it's often the opposite. Smart people can fall even harder for biases because their ego, which is reinforced by their intelligence, convinces them that this stuff only applies to, other less intelligent people.
So they end up generating more sophisticated, more complex rationalizations for their bad emotional decisions.
Exactly. And this leads to what Faulkner calls the post hoc problem.
The great financial self-deception.
It is. A trader makes an impulsive, emotionally charged System 1 decision. Let's say he buys a stock because he heard a hot tip at the gym.
The decision is made. It's purely emotional.
Purely. But then he engages his powerful System 2 logic after the fact to rationalize it. He'll spend hours researching the company's fundamentals. He'll generate spreadsheets, run projections.
It's all to justify the purchase he already made. He'll ultimately claim the decision was totally rational when it was fundamentally based on gut feeling.
It's just the brain covering its own tracks. The decision was already made emotionally. All the reasoning that comes later is just elaborate performance art to maintain the narrative of, I am a rational decision maker.
And this post hoc rationalizing is heavily influenced by how we view financial heroes. Faulkner makes a really strong claim here. He says that famous figures of finance, Buffett, Soros, Dalio, are essentially fictional in the public mind.
Fictional? It is a strong claim, but when you break it down, it's accurate. We don't know these people through scientifically verifiable, repeatable strategies.
We know them through stories.
Incomplete, sanitized public stories. The hero narrative. We read about their greatest wins, but the complexity, the failures, the lucky breaks, the immense psychological costs, all of that is edited out.
And even when they try to explain their own process, they're subject to hindsight bias and availability bias. They can't even articulate the whole messy truth of how they made their decisions.
Right. So the consequence for the average person is that they go looking for an easy story, that one magical insight that made someone rich.
Instead of developing a verifiable strategy.
A story is comforting and quick. A strategy requires the nitty-gritty, difficult work of quantifying your edge, setting our multiples, and accepting the reality of statistical failure.
Faulkner goes even deeper, though. He goes into the unconscious mind by looking at the role of money itself.
Right. Beyond just being a medium of exchange, money is the most powerful and pervasive metaphor we use.
We use it to measure almost everything in our lives. Did that meeting pay off? Is this relationship worth the investment? I just spent too much time on that project.
And the specific metaphor your subconscious mind attaches to money will dictate your financial behavior. For example, if your subconscious views money as safety, a barrier against a dangerous world, then trading.
which requires you to deliberately put that safety at risk every single day.
Is going to generate crippling emotional stress. It will lead to system abandonment. Or if you view money as power, then losing it feels like a total emasculation.
And that leads to dangerous revenge trading. I'll get it back.
Exactly. Let's take another one. What if your subconscious sees money as a liquid?
A liquid? How does that play out?
If money is a liquid, then losses aren't seen as a discrete event like hitting a stop loss. They're perceived as a constant passive drain. It feels like your capital is just slowly leaking away.
So it feels psychologically easier to just hold on to a losing trade and hope you can stop the leak,
rather than taking the decisive, painful action of cutting it off completely. The short-term emotional pain is lower, but the long-term behavior is disastrous.
So what's the better metaphor?
A successful trader needs to see money as a tool, or maybe ammunition, something that is meant to be spent, deployed, and recycled efficiently to achieve an objective.
Okay, so we have this flawed System 1 programming. It's based on emotion and these deep metaphors. We know that logic, our System 2, isn't enough to fix it. So how do we actually change the subconscious programming?
Faulkner's answer is that you need reference experiences.
Reference experiences.
Your System 1 brain doesn't learn from spreadsheets or logic. It learns from sensory, emotional reality. If a trader intellectually understands they must accept loss, but they physically freeze up when it's time to hit the sell button, that's a neurological conflict.
So they need to train their System 1 brain to get comfortable with the actual sensation of letting go of value.
It's like a form of desensitization. Let's take that core issue. The struggle with accepting a loss, which is really about giving up value or control.
Okay, give us a concrete example of a reference experience, something you can do outside of trading that could build this skill.
Faulkner suggests practicing small, low-stakes behaviors that involve that same feeling. For instance, go through your closet and give away clothes you still like, not just old junk, to a thrift shop. Or perform a totally unexpected, non-reciprocal act of giving. Just hand someone $10 or $20, a stranger maybe, for no reason at all.
The point isn't the monetary value.
No, the point is the feeling. The act of relinquishing control, of giving something up and getting nothing tangible in return.
That small repetitive act trains the underlying neurology, the System 1, to become comfortable with that sensation of letting go.
Yes, it diminishes the emotional charge that you've associated with financial loss. Over time, that low-stakes practice makes it neurologically easier to execute the strategy of accepting a fixed 1-hour trading loss without that immediate, overwhelming spike of fear or feeling of personal failure.
Ultimately, this whole journey of self-mastery leads to what you could call the expert level of thought. Faulkner talks about 5 minds of development, and he says expert traders operate at the higher generative levels.
These are people who have transcended the need for simple, satisfying cause and effect explanations. They understand the limits of language and linear logic.
They've moved beyond trying to predict what will happen
to focusing entirely on how to react to what is happening right now. They are concerned only with objective, observable reality, not their story or interpretation of why it's happening.
This is just perfectly captured by that famous, almost Zen-like quote from Ed Seykota, the legendary systematic trend follower.
Yes.
Someone asked him, what is making gold go up? And he didn't give them some geopolitical analysis or a lecture on supply and demand. He just replied,
it has the property of going up.
It has the property of going up.
That statement is the generative mind in action. It completely rejects the need for satisfying linear stories. It focuses only on pure trend recognition. For a trend follower, the only information that matters is that the market is moving higher. The why is just irrelevant noise.
And that purely objective approach is impossible to achieve if your subconscious is being ruled by ego, by fear, or by some flawed metaphor about what money is.
We've done a really deep exploration today. We've gone way beyond chart patterns and headlines into that internal architecture that's required for sustainable market success.
We've covered the necessity of psychological deprogramming to deal with our hidden beliefs, which we got from Tharp.
The unforgiving reality of statistical risk and variance from Elder.
The mathematical primacy of position sizing over finding the perfect entry, and the incredible power of our unconscious financial metaphors from Faulkner.
And I think the actionable synthesis from all of this is crystal clear. Stop the relentless and, frankly, ruinous search for a better entry system. It's a dead end. Your focus has to shift entirely to the 3 pillars of internal mastery.
Okay, pillar 1. You have to implement a system that generates radical objectivity. And that means relentlessly measuring the cost of your mistakes.
And remember Tharp's definition. A mistake is simply when you fail to follow your own rules.
Right, and you have to quantify those mistakes precisely in R multiples. This forces your brain to see indiscipline not as a fleeting emotion, but as a measurable, real-world expense.
Pillar 2. You must accept down to your bones that certainty is impossible. You have to shift your focus from the ego-driven goal of maximizing every single outcome
to the process-driven strategy of probabilistically strategizing over the long run. You have to understand that losing streaks aren't system failures. They are the normal statistical cost of doing business in this field.
And third, you have to scrutinize your gut feeling. Every single urge you have to deviate from your pre-planned strategy must be treated with extreme suspicion.
Acknowledge Daniel Crosby's truth. The most profitable path in the moment often feels fundamentally wrong because it forces you to act against your innate, flawed emotional programming.
You have to automate the rational lesson to handcuff your impulsive self.
Alexander Elder taught us, through his own incredible experience, that the very best buying opportunities, the moments that can launch incredible wealth, they occur at the point of maximum danger.
Right when the panic of the weak hands is complete.
So if success is truly predicated on admitting your own mediocrity, as Crosby says, and on accepting that your emotions are often charged by illusion, as Tharp teaches, how will you ensure that when that moment of maximum danger arrives, the ultimate test of your discipline, you actually execute the strategy you planned in the quiet, rational calm of your preparation?
Your final thought for today, something to really reflect on, is this. What one fixed, quantifiable rule will you solidify and automate today to definitively handcuff your impulsive self? What's the one thing you can do to ensure that when the market starts screening, you respond not with your fear-driven system one, but with your automated, pre-vetted professional strategy?
That decision right there is the fundamental difference between surviving and thriving in the world of statistic causality.